Hi, this is Richard Vague with Tychos. Today we're going to talk about equity-linked derivatives. At Tychos, one of the main things we systematically do is look at the big numbers in the economy of the 7 largest countries in the world, especially debt numbers, and see where there are truly big changes or disruptions in trends. For example, in 2002, household mortgage loans in the U.S. were $5 trillion, and by 2007 they were at $10 trillion. That was by far the most out-of-pattern, disruptive growth in mortgages in U.S. history. And since loan growth that rapid is almost always evidence of irresponsible, profligate lending, there was almost no chance there wasn't to be some consequence. And of course, that consequence was the global financial crisis. Of course, the macroeconomics profession was not looking at those numbers, but that's another story. That was coupled with an even more astonishing and disruptive growth in mortgage-linked derivatives. In that case, the credit default swaps, which grew from 6% of GDP to 110% in just 5 years. Let's look at China for another big change in a key number. Total business debt, which includes CRE or commercial real estate loans, are another case along these lines. They totaled 94% of GDP in 2008 and had grown to 158% by 2022. There's almost no chance this runaway debt growth can avoid cascading into problems in China's economy, and we have already seen major cracks in the form of the Evergrande and Country Garden debacles. These were not subtle, hard-to-detect trends, and we would argue that big economic disruptions, both good and bad, almost never are, pandemics and wars aside. So what are the big out-of-pattern trends in the U.S. right now? Well, there are very few, given that conventional private debt growth as a percent of GDP has been flat to down since the 2008 crisis. We have seen some pockets of problematic loan growth, such as private placement lending and student debt, but these are relatively small slices or sectors in the grand scheme of things. We also have, an upward trend in government debt, which we have spoken about in other videos. But there is one trend we would draw your attention to, and that is in equity-linked derivatives. In the past 13 years, these have grown from 4% to 20% of GDP. These primarily consist of futures/forwards, swaps, and options. With a future, you commit today to purchase a certain amount of a given stock in the future, say 6 months from now, at a specific price. In doing that, you are making a bet that the price of that stock will be above the level you have committed to at that future date. Someone on the other side is typically committing to sell at that time and at that price. An option is similar, but it is the option to buy or sell at a given price before a specific date rather than the commitment or obligation. Many of these transactions never get exercised, or if they do, they get netted as they occur. For example, if you buy a futures contract to purchase 1,000 shares of Apple stock for $180 a share in this coming December, and by that time the price is $185, you could spend the money to buy the stock outright completely and then sell it outright to make the $5 gain, but most are structured in a way that allows you to simply get the $5 gain without having to buy and then sell the actual stock. Nevertheless, especially if the price goes against you and the markets are under stress, you could be on the hook to take a big loss or even have to buy the shares outright. So they are a liability to you in essence, a form of debt, though it is not recorded in that way. And like conventional debt, they are all two-sided. For every obligation to buy, there is a corresponding obligation to sell. For every option to buy, there is an obligation to sell if that happens. To get a sense of the magnitude of that potential liability, I mean, how much commitment really are we talking about? We look to what is called the notional amount of the derivatives. And in the case of equity-linked derivatives, that notional amount is $5.5 trillion. More importantly, as we see here, it has been an amount that has been escalating rapidly. We've said elsewhere that it is the increase in debt that is a big part of what causes asset values to rise. And we believe that is at least indirectly true in the case of stock prices. More debt brings higher stock prices. We can see that most clearly with margin debt. And we have written elsewhere that the aggregate growth in overall debt in an economy over time has helped boost stock prices. These prices correlate more closely to total debt, frankly, than they correlate to earnings or GDP, as an important example. So you won't be surprised, given all that, to find that we believe there is at least some correlation between the implied debt of the notional value of equity-linked derivatives and aggregate stock values. In other words, the more derivatives, the higher stock prices will go. And thus, that creates a vulnerability. High levels of debt taking stock to a high price create a fragility. It might precipitate some kind of reversal. Now, we're not predicting a stock market crash, though a run-of-the-mill correction of 10% or 20% of the stock market would not be unexpected. We don't want to make light of a correction of that magnitude, but those kinds of corrections have actually happened frequently. But we are saying that the edifice of debt, direct and indirect, upon which stock values are built, which includes, as we've just discussed, margin debt, overall debt generally, and at least some part of the notional value of equity-linked derivatives, creates an edifice that makes them more fragile and more vulnerable to the possibility of a correction. So we need to keep our eyes on the growth in equity-linked derivatives. That's it for this week. Thanks.